Where will the S&P 500 index be over the next 6 to 8 weeks? In this video, we're going to focus on a technique called probabilistic analysis. We're going to lay out 4 potential future paths for the S&P, talk about what those scenarios might look like, watch the 4 scenarios, then vote in the comments below. Drop a comment. Which do you see as the most likely scenario and why? Before we get to the 4 potential scenarios, here's one more thing I wanted to tell you about.
I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here.
So for this exercise in probabilistic analysis, we're going to use this particular chart. We're going to talk about 4 different scenarios, from the super bullish, the mildly bullish, the mildly bearish, and the very bearish. We'll talk about each of those 4 scenarios, what they might include, what might actually create those potential future paths, and then think about what that might mean for a portfolio given each of those 4 scenarios. Now, before we look at the current one, let's actually look back at the one that we did previously. Back in mid-January, we did another one of these videos for the S&P 500. This was the actual chart that I used. Wanted to update you on what happened since then. We laid out the 4 scenarios. The very bullish scenario, which at that point, if you remember where we were at, this was the S&P rallying off the October 23 low. At the end of December, we sort of topped out around 4,800. The first couple weeks in January were a little more choppy. So the question was, were we going to break out to new highs or not? That was sort of the key question. And then if we pull back, how painful would it potentially be? Look at how beautifully the market almost identically followed the arrow that I drew for the very bullish scenario. Scenario number 1 was spot on correct. It turns out that the leadership that we experienced in Q4 with those mega cap names, the Magnificent 7 names, really continued in January and February. What changed in January and then into February were all the other stocks that started to participate, right? In October, really November, December, it was sort of the Magnificent 7 stocks working, and then a lot of other things were not, so the breadth conditions were a lot weaker. In January and February, all of a sudden the breadth conditions started to improve because all these other sectors like financials and industrials and others really started to participate in the uptrend, along with all the other growth stocks that started to work. So for the 6 weeks from mid-January to really the end of March, scenario 1 was absolutely spot on. The other scenarios that were more bearish, and the mildly bullish to the super bearish scenarios, those really dealt with the unwinding of the rally that we saw in Q4. It never really happened. January, February, March ended up being some of the strongest performance we've seen in a Q1 in quite some time. Q1 in an election year is actually often quite weaker than this. Arguably, one of the takeaways from that strength in scenario 1 was that we were probably going to get a pullback, which arguably we've now seen here in April. Maybe the fact that we delayed that a little bit, just kind of pushed it down for about a month, caused the severity contributed to the severity of the decline that we saw the first couple weeks in April. Now you can see, of course, we've had that initial sell-off in April. We've now rallied. Bulls that I've spoken to are super bulled up, saying, yep, that's the bottom at 49.50. This is the buyable dip. We're going to new all-time highs here in the next 6 weeks. I've talked to very bearish analysts who say that was wave 1 or wave A. We are now having a counter trend rally or a dead cat bounce before the next big leg lower. Which of those do you agree with? Let's go to the current chart. I'll lay out the 4 scenarios. Don't forget, the point of this probabilistic analysis is to think about each of these 4 scenarios, really think about what they might look and feel like. Then drop a comment below. Tell me which scenario you vote for and why. Tell me why you think that's the most likely scenario. As we just did, we'll revisit those scenarios here down the road a bit and see what actually proved out to be correct. And the point of this analysis is to think outside of your current positioning, think outside of your current biases, and just open yourselves up to 4 different potential future paths. Scenario 1, the very bullish scenario, would basically mean this was a brief pullback. This is a very buyable dip. We've now seen the low for Q1 and now Q2. Scenario 1 means we push aggressively to the upside. Not only do we break to new all-time highs above 4250, we don't stop. And scenario 1, that very bullish scenario, would mean we get up to, we'll call it 53, 54, even 5,500 by the end of the second quarter. Now, what would actually cause that to happen? Well, I would say you're seeing this week here, this bounce, and I would say a lot of this, particularly on Friday, is driven by mega cap growth stocks with strong earnings. Names like Alphabet, paying a dividend for the first time, crushing estimates. That's what would need to happen, and this would be just the beginning. Downside surprises like we've seen with Meta and Tesla are short-lived. They now see buyers come in and push those stocks higher. Right? The only way their growth-oriented benchmarks are able to make new all-time highs in the next 6 to 8 weeks, it would have to be the biggest names doing some significant gains of their own. So all those sort of previous Magnificent 7 stocks would have to be going up. The biggest names like Alphabet, Meta, Amazon, Netflix, and others would most likely have to be making new highs as well. Apple and Tesla, some of those names that had got crushed a little early, would have to probably fully recover from the pullbacks that they've experienced here in the last couple weeks, last couple months. What would also mean would most likely be economic data comes in weaker. We've seen some overheated inflation data, overheated economic data in the last week or two, and that's really contributed to the market decline in April. We'd have to see not any more of that, I would say, because stronger economic data is going to weigh on risk assets. You'd have to see inflation indicators come down closer to that target of 2% year over year for the CPI, which is what Fed Chair Powell has mentioned many, many times. They've mentioned how data dependent they are. So you'd have to see economic data show some weakness, which would give the Fed governors confidence in starting to cut rates. And I would say the bullish scenario number 1, would have to involve the first rate cut probably coming at the June meeting, and expectations between now and then sort of pricing that in. You'd have to have a couple more rate cuts in 2024. Scenario number 2 is the mildly bullish scenario. Okay, but not great. I would say in this scenario, we kind of drift slowly higher. And even though after this initial bounce lower, people are sort of in the, are we going to new all-time highs, or was that the beginning and we're going to go a lot lower, right? People sort of are forcing themselves into the very bullish or very bearish scenario. Remember, those are sort of those more sideways scenarios, more of those back and fill type of scenarios where it's not going straight up, but it's not going down. I think scenario 2, that mildly bullish scenario, is where we kind of drift higher. We probably don't make new highs. We probably stay below that 5260, 5270 that we established at the end of March. But we don't go any lower, right? And that low around 49.50 from mid-April holds, right? So I would say we remain below the recent low and the recent high, and we're sort of range bound. So certainly not bad, but not great. And I think in that scenario, you got a lot of maybe divergences, right? Some of the Magnificent 7 do quite well, like Alphabet certainly appears to be pushing to new highs, but others like Tesla struggle. And so the struggle with some of those mega cap names probably causes the market to drift slightly higher, but not significantly higher. Scenario 3 would be the mildly bearish scenario. In this case, I don't think we go much higher than this, and we probably undercut the April low, but not to a significant degree, right? So instead of the market going to zero, right, and sort of an aggressive sell-off, it's more of a slow drift lower. There probably are some names that work in this environment, but probably the economic data that we're looking at in the next couple of weeks comes in a little heavier. So you continue to see signs telling you that the Fed is either not going to be able to do a first cut in June, or at least is probably going to do less cuts through the course of 2024, given the economic data that's not weak enough, given the inflation data that's still not getting down to the bogey of 2% year over year for CPI. Fed governors are hesitant to be too aggressive lowering rates because again, still want to slow down the economy. And so they're, remaining interest rates remaining elevated, probably the 10-year yield drifting higher, puts a limit, sort of a natural limit to upside movements for stocks. And so risk assets kind of struggle to gain any footing. The April low was not the low for this downdraft, and all of a sudden 2024 in Q2 looks a lot like Q3 or Q3 of 2023, sort of back in this period where we had a multi-month decline of a series of lower lows and lower highs. You also always have to have a very bearish scenario, something that's just really negative. So scenario 4 for me, I think the very bearish scenario over the next 6 to 8 weeks means we break below the 38.2% retracement around 48.20. We break below the 200-day moving average, which is currently around 4,700. We're probably a lot closer to this 61.8% retracement, which is around 4,550. I don't know if we get much lower than that. I mean, if we do, that would be an aggressive version of scenario number 4. But I think in any case, breaking below the 200-day over the next 6 weeks would be a pretty negative outcome. What that, of course, would mean would be the first sell-off here into April was a wave 1 or wave A. We have a counter trend rally right now. We quickly turn lower and start to really sell off. What this would mean is that the mega cap growth names would really have to struggle. Probably a lot of other sectors like energy and materials, instead of recovering now, either have limited gains or just not enough market cap there to move the benchmarks higher. The NASDAQ 100 ends up being a fantastic shorting opportunity because we go full risk off. You'd probably in this scenario see a lot of economic data come in a lot hotter than expected, indicating that the Fed would be nuts to try to lower rates or lower rates aggressively. They probably start talking about pushing the first rate cut out to a later meeting in 2024. The moment they would say that, that would cause risk assets to go down pretty quickly. Maybe the only thing that rallies in this scenario is the U.S. dollar, and we go back to that 2022 phenomenon of the U.S. dollar being the wrecking ball for risk assets, as that's one of the only things that does well. Maybe gold hangs in there as a decent bet away from stocks, but overall risk assets are a dangerous place to be. Which of those 4 scenarios do you see as the most likely for the S&P 500 over the next 6 to 8 weeks? Don't forget to drop a comment below with your vote and what you think is going to drive that particular scenario. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.